Well, good afternoon, and thank you for coming to today's session of New Knowledge. I'm thrilled. We have tried many times to have this presentation because we feel like it's the most important thing that you will do in business, which is understanding your cash flow statement and being able to do a break-even analysis. So we're lucky enough today to have Karen and Rodney Jackson with Hickok, Brown and Company. And without further ado, I'm going to introduce Karen and Rodney.
Great, thank you. We're just going to start with a quick introduction and then we'll kind of jump into our two topics. I'm Karen Jackson. I'm a partner at what is now HBC Certified Public Accountants. We're actually in the process of changing our name from Hickok, and Company, so you may see some things, like our business cards still say Hickok, and Company. We're still working on all the signage and that kind of thing, but we are moving to HBC Certified Public Accountants. I've spent probably 25 years in this industry, most of which was in public accounting. I did have 2 years at a large public company, but my background is primarily in public accounting, and I've spent most of that on the assurance side. So I do tax and assurance, but most of my background is reviews, comps, audits, and primarily with nonprofits and governmental entities. My partner in crime has a little bit different background, but I'll let him just introduce himself and kind of give you what his background has been.
My name is Rodney Jackson. I've been in accounting, actually as of today. I started in accounting in 1985 on July the 18th, so today is actually, what is 30, how many years that is?
Mm-hmm.
Yeah.
We stopped counting at
33, so tomorrow I start my 34th year of doing this. I did leave, I was in public accounting up until 2003. I left private accounting at the end of 2010 and went back into public accounting. I've been in public accounting ever since. I've been a sole practitioner, a partner in a two-person firm, and now I'm a partner in Hickok & Firm.
Great. So, I'm going to have to do this manually, guys, so try not to keep walking in front of your screen.
Oh, you're fine if you just stand right there.
Right here?
Yeah.
Okay, we'll stand right here. So our objectives today are two things. One, it's going to be understanding and analyzing the cash flow statement to help you manage your business. And then the second piece will be understanding a break-even analysis, and we'll go through a calculation of how to do that for your business. So when I asked what our audience was going to be, I was told that it was probably going to be largely people who either have little experience with this area or none. So, and we've kind of done these examples for a for-profit business, but you can also apply this to a nonprofit. This can be a sales business. It can be a retail type business. But I want to just get an idea of what my audience is. So how many of you in here maybe either own your own business, thinking about owning your own business, have owned your own business? Anybody an owner? One? Okay. Primarily the rest of you work in a for-profit type business or nonprofit? Okay. So we're going to kind of cover the whole gamut. So even if you don't own a business, or you're an employee, or if you happen to be a board member, maybe you're a board member on a corporation, maybe you're a board member for a nonprofit, your auditor comes and presents these statements and you're thinking, I've never really understood what these mean or what questions I should be asking. So hopefully this will help a little bit. Okay. And I'm going to kind of go over the cash flow statement, and then Rodney will pick up on a break-even analysis. So before you can understand a cash flow statement, you have to understand what the inputs are into calculating that statement. So you start with a balance sheet and you start with an income statement. Now, in the purest sense of accounting, you have cash basis accounting, and that everybody seems to understand. That is, I sold something, whether you sold a service or you sold a product, you increase your cash and you increase revenue, right? So your change in profit is the same as your change in cash. And then on the flip side, if you pay a bill, pay an expenditure, right, you increase expenses and you decrease cash. So again, any change in your net profit or net income is going to be the exact change in your cash. Okay? But when you move from a purely cash basis form of accounting to what we would call full accrual accounting, or GAAP, which is generally accepted accounting principles, you start adding accruals for things like receivables, payables, accrued wages or other expenses, debt, fixed assets. And when you start changing your balance sheet for those items, when you change your balance sheet, which then also affects your income statement, that income statement may change up or down, but it's not exactly equal to how your cash changes. So what the cash flow helps you do, once you're on an accrual basis of accounting, is say, okay, I made $10,000, I made $100,000, where's my cash? Why did I not see that same increase in cash, okay? So it helps you reconcile where did your money go? You made money, but where did the cash go? I don't have that in my hands, so where did it go, okay? Okay, so what I did is I just created a very simple example. It's called Jones Inc. This could be a service business. It could be a retail business, but this looks more like a for-profit business. If it was a nonprofit, down here at the bottom, you would have change in net assets instead of stockholders' equity. Other than that, the balance sheet could also be a nonprofit, okay? So you have things like cash, you have receivables. If you're a nonprofit, instead of trade receivables, maybe that's a grant receivable. Inventories, you have prepaid expenses. That's usually largely insurance if you're prepaying for insurance, or if you're prepaying some kind of contract, maybe a maintenance contract. Fixed assets. It's very common to see lines of credit. It's also common to see some type of long-term debt, usually secured by property. Accounts payable, accrued payroll, that could also be accrued vacation, accrued other compensated absences. And then in this case, I did stockholders' equity for a for-profit. Like I said, if you were nonprofit, you would just substitute net assets, okay? All right, so that's just a very basic balance sheet. And then an income statement for the same company might look like this. You have sales. That could be fee revenue if you're a service business. It could be sales of products. If you were a nonprofit, instead of sales, you would see things like state and local grants, federal grants, contributions, maybe some program income if you're charging something. And then you come down to cost and operating expenses. Most for-profit businesses, if you're some type of retail or manufacturer, you'll see cost of goods sold. Everybody's got payroll, utilities, supplies, repairs and maintenance, depreciation and amortization. Those are pretty common across all types of entities, okay? And then sometimes, depending on how you prepare your financial statements, you might have some other income. If you've got debt, you'll generally see interest expense separated from the rest. So again, a pretty simple statement of income. So once we have those, then we prepare the cash flow statement. Okay? You can't prepare your statement of cash flows until you have your balance sheet done and your income statement done. And I will be honest with you, this probably trips up accounting students more than anything else. We usually get the balance sheet pretty easy, and we usually get the income statement. But even for accounting students or accountants starting out in their careers, this one seems to be the most difficult to really grasp. Okay? So what I did is for the 2018 year, I prepared a statement of cash flows, and I tried to come out here and tell you where these items are going to come from. Okay? So when you start out with the cash flow, the first thing you start with is your net income. So if you go back to your income statement, you will see that's the last line on your income statement. So that's where you start your cash flow statement, okay? But you had net income of $40,000. However, if you're looking at your balance sheet year over year, your cash only went up $3,600. So most people would look at that and say, okay, where's my money? I made 40, but I don't have an additional $40,000 in cash at the end of the year. Where'd it go, right? So that's what the cash flow statement is going to try to tell you, is where that cash went. Okay?
I'm sorry, is that included
Yes, ma'am, it should be. You see it, sorry, it might be a little small. I tried to get that as big as I could. Okay, so we know where we're starting with from our statement of income, right? That's just our net profit. It could be a net loss if we had a net loss, and everything would be the same. And then the first area that you come to on a cash flow statement, they call it adjustments to reconcile. But these are non-cash items that are running through your income statement but don't affect cash, okay? The most common that you're gonna see, whether it's profit or non-profit, is depreciation and amortization and bad debts. There are some others, we can get way more complicated than this, but those are probably the most common that you're going to see, all right? So when you buy a fixed asset, right, it doesn't go to expenses, you set up an asset, and then you start depreciating it year over year. So that depreciation expense hits your P&L, it decreases your P&L, but it doesn't decrease cash, okay? So this is gonna help us reconcile our change in net income to where we get down to our change in cash, and that's where we're heading. We'll start with net income, and we're gonna end with our change in cash, okay? And then the next section, and all of this first part, so it's divided in three pieces. The first part is, here's how I spent my money for operating type activities. Here's how I spent my money for investing type activities. And here's how I spent my money for financing type activities. So the cash flow also sort of helps you know what was operational, what did I invest in, which the most common is purchasing of fixed assets. And financing is usually changes in debt, and again, if you're a for-profit, you might have stock issued, stock redeemed, things like that, okay? So within your operating, after you kind of pull out those couple of items that are non-cash expenditures, or they could be income, those usually come from journal entries. Those are not going to come from transactions that you've booked. You're going to look at your changes in your operating assets and liabilities. So if you go back to your balance sheet, it really goes right down your balance sheet, with the exception of cash. So that's your receivables, your inventories, prepaids, not your fixed assets, because we're going to talk about fixed assets down here, accounts payable, and accruals. Okay, so it's everything except cash, fixed assets, and your debt area is all going to be in here. Okay, so for instance, if we were to look at trade and other receivables, if we go back to our balance sheet and we look in this case, this is for the year ended June 30, 18. Okay, so we're doing year over year. We see that our receivables went from 5,000 to 10,000. So we actually had an increase in receivables of 5,000. I hope my numbers are right. Why do I not feel like that was the number over here?
It's net of bad debt.
Oh, net of bad debt, sorry. I picked the most complicated one to start with. Okay. Normally,
Bad debt's not separate on the balance sheet. so.
yes, thank you. I was like, I don't think that was 5,000 when I knew. So normally you would see a decrease of $5,000, which would match the change in your balance sheet. Not to get too technical, but one of the things, when you change this, you've already pulled $1,000 in the bad debt. So it's actually your balance sheet change in receivables plus your bad debt from above. Okay? Now that starts to get a little bit complicated. Most of them are easier. If you went to inventories, prepaid, accounts payable, and payroll, and you look at your balance sheet slide, those numbers are just going to be either the increase or the decrease in those line items on your balance sheet from FY17 to FY18. So it's that simple. But that just tells you that my income changed, but my cash didn't change by the same amount. For instance, receivables. So your receivables went up $5,000, right? What that means is we booked a receivable and we booked a related revenue. So that profit, that increase in profit is up here, but we haven't collected that cash yet. So it's not going to be down here yet. It's not going to be down here until we collect the cash. But that's letting you know that part of that difference from profit to cash is the fact that you increased your receivables. You don't have the cash for that yet. So it's coming, okay? It's actually coming. And then it's kind of the same thing with each of those other items from your balance sheet, whether it's an increase or decrease. Okay? And then what you do is you add all these together to get to your change in operating activity. So in this case, we have a positive, so this means we had net cash provided by operating activities. Okay? Our cash theoretically should have increased by this amount from operating activities. Okay? So then you move down to investing, and there can be some other things in investing, but primarily it's your changes in fixed assets. Okay? So in this case, if you went over to our balance sheet, our fixed assets changed. They didn't change 40,000 because, like with the trade receivables, you have to back out the depreciation expense. So our fixed assets actually changed $30,000. Okay, it increased, so theoretically we bought $30,000 of new assets this year. However, included in that number is $10,000 in depreciation expense, which is reducing that change. So when you add that back, we actually spent $40,000. Okay? So if you took the 40 less the 10,000 in depreciation, that's your change on the balance sheet in fixed assets. So what this tells you is, okay, I did all my operating transactions. My cash should have increased $63,500, but because I bought $40,000 in fixed assets, now my change in cash is really only $23,500 increase. Okay? It's kind of letting you know where's my money going. And then the final piece kind of this puzzle as you come down is the financing activities. So this will be, in this particular example, your line of credit, and then you have some long-term debt. So you've got a mortgage note receivable or a mortgage note payable. Might not be secured by debt or by property. Might just be a long-term loan from a bank. Okay? So we actually, our line of credit is on the balance sheet. Our line of credit went from $50,000 to $40,000, so our debt actually decreased $10,000. Right? But on that line of credit, you actually had some ups and downs. You did some draws during the year, and you paid some money back that resulted in that $10,000. But what happened is you actually drew $20,000, which increases cash, but you paid back $30,000. That's how we get our net of 10, paid back 30, which decreased your cash, okay? And then same thing on debt. So you didn't get any new debt this year, but you did pay $10,000 on the debt you already had, right? So we know that's where another $10,000 of my 40 went. And in this case, you know, the owner put in another $100 in cash for capital. Okay, so they inserted another $100. And so when all that's done, what that's telling you is your financing activities actually cost you $19,900 in cash. Okay? So then, now that you've looked at it by category, operating, investing, finance, you come to a total. Okay? I'm sorry, right here. You come to a total. Right here. My net increase or decrease in cash and cash equivalents. In this case, my net cash went up $3,600. That's a result of a $63,500 increase from my operating activities, less the $40,000 I spent in investing activities, less the $19,900 I spent in financing activities. So I made this much money on an accrual basis, but my cash only went up $3,600. And then the last part is just taking you from what was my beginning of the year cash and my end of the year cash. So if you go back to your balance sheet, cash and cash equivalents for 17 should be $2,000. Cash and cash equivalents for 18 should be $5,600. And then this down here, there's another required section that's really disclosure information. But once you're on an accrual basis, they want you to tell the reader how much you actually paid for interest and how much you actually paid for income taxes if this is a taxable entity. So these numbers are not in addition to the top, they're already included, but they're just some numbers to let you know. Because if you were to look over at your income statement, if you had accrued interest, your interest expense may not be $20,000, it might be something different, okay? So they want you to tell how much cash. And that's really it. That's basically how a cash flow statement is created. It can definitely get more complicated as you have a more complex business. And when we get to the end, if anybody has any examples from their business or, you know, an entity that they serve with, if you want to talk about where some of those items might fall out on here, we can talk about that. Does anybody have any questions so far on this, or want me to go back over how we got to the cash flow statement, or what it means, or what it should be telling you about your business or your entity?
So it's actually the change in cash from one year to the next.
Yes.
Fiscal year.
Yes. And reconciling that back to your net income. Yeah, it's basically relating that piece of your balance sheet to your income statement.
And so a couple things you can take away from the cash flow statement, do you agree, like, your depreciation and amortization is, of course, you know, it's actually gonna be something that you're gonna wind up having to reinvest at some other time
Yes.
in your business life, because you're depreciating something that its useful life is going away. And so if you had the cash flow to do it, you could take that depreciation number, whatever that is on the depreciation.
Yeah, you could say, for instance, I want to put, I think this is where you're going, I want to put $10,000 back into my business every year, because eventually, after I've done this for however many years, that equals the useful life, I'm not going to have any assets, but I may not have any cash either. If I've already used up all my cash on other things, I now need a vehicle, I need machinery and equipment, I need a computer, and now I've got no money. Is that kind of what you're saying? Yeah. Yeah.
Because that's one of the things that you can take away from that, is that is a deduction off of basically off your taxes. However, you didn't spend it, so you probably ought to put it back, because you're gonna have to buy whatever it is you appreciate.
Right, right. Or plan for that with some cash flow projections, but no, you're exactly right. And I hear that all the time. And again, there are very simple businesses out there, there are very complex, large corporations out there. But one thing we hear a lot, particularly from maybe more of a sole proprietor or a small business, is, well, you know, that number doesn't really mean anything. Because a lot of times they really just want to deal in cash. And Rodney can probably talk more about that. He does a lot of consulting with smaller businesses, but they kind of want to ignore that number because it's not a real number. It's not cash, it doesn't mean anything. And that's fine if you're only looking at the short term for your business, you're only looking at this year. But if you're looking at the long haul for your business, Kathy's exactly right. At some point, you're going to use up the equipment that you are needing to produce that service or produce that widget, okay? You're eventually going to need that, and if you spend all your cash because you don't think that's a real number, then you're going to be without the assets you need to run your business and have no cash to do that. Then
There used to be a threshold, and I don't remember what the number is now, but that you can purchase something that's going to last more than a year, but you can still deduct it all that year instead of putting it on a depreciation statement. What is that number?
now, are you talking from a tax perspective?
Yeah.
Okay. So there is no number that anyone, that either the IRS or Undergrad or anybody's come out and said, this is an official number you can use. It's management's decision.
You're talking about
Capitalization, yeah.
No, she's talking about expensing, section 179.
Oh, are you talking about 179?
Yeah, I'm talking about expensing things that could be capitalized, but there is a number that you can expense in there.
Depending on what state you were in, last year the number was 500,000, but some states reverted back to the old tax law of 25. So, and I think the new tax law actually changed again. I'll be honest, I don't know what it is at this point.
So as far as computers, you know, that's what
You
a
just
lot
write
of
them off.
offices are using now.
Yeah.
A lot of people use $500,
Yeah.
but there is no official,
Yeah,
you
they're
can
not,
get,
it really depends on, if you're a $100 million company and you're expensing $1,000 laptops, they're never gonna question it.
your auditor's not gonna question you, the IRS is not
If
gonna
you're,
question you.
if you're a sole proprietor graphics design guy and you buy a $3,000 computer, they're gonna want it on your balance sheet. Now, you can still 179 and take the whole deduction, but they're gonna want you to treat it as an asset, not basically a disposable item. Same thing with printers. I mean, when I was with the explosives company, we were between 26 million and $100 million. We buy $500 or $600 piece of equipment, we expense it. Because our depreciation schedule was already 25 pages long. So we just expense stuff.
Yeah, so there's no number, and there's no one number that covers all businesses. It is a management decision,
But if you make the management decision, if you're a small corporation, or even if you have a procedures policy, if you're a sole practitioner, and you say, hey, I'm writing off everything under 1,000, they'll honor it. They're okay with it.
as long as you don't get crazy, as long as you
Right,
don't
as
get
long as you don't
crazy.
get crazy.
Because the IRS wants their tax money, so they don't want you writing off.
But in the real world, this statement, unless your only asset in your business is a bank account, this is the most important statement you can look at, and it is the one that is the least used by small business. And it's the most important one they got. Because the guys I deal with come in and they get a tax, let's just say that they're on accrual basis for taxes, and this is their final numbers. You gotta go tell a guy that just gained, how much did he gain?
$3,600.
$3,600 this year in cash, that he's now gotta go pay $8,000 in tax, plus state. So he's gonna go pay a little over $10,000 in income tax. And he's gonna say, well, I don't have any money. How in the world is it possible? There's no way I could have made 40 if I've only increased in cash. You'll say, well, no, because you got debt that you pay now. And that's the hardest thing, one of the hardest things to grasp is if you finance equipment, building, anything you finance in a business, when you pay that debt back, it's automatically income because you can't deduct the principal payback. Now, you're going to deduct the interest that's paid, but you don't get to deduct this much back. So if he did nothing, if nothing else changed, if all they did was bring in just enough to service their debt, he's still paying tax on $30,000. There was no way his income was going to be less than the 30 that he or the 10 that actually he repaid in long-term debt. This doesn't matter. This does. He's paying tax on that regardless of what's in his bank account.
Right. And so, tell me, of course, we're getting off of cash flow, but for a second, but the difference in a sole proprietor and an LLC, do LLCs are taxed like?
LLCs have a default tax classification as a partnership if they have more than one member. If there's only one member, then it's considered what the IRS calls a disregarded entity. So for tax purposes, it doesn't exist.
It's just treated like
It's
sole
still sole
proprietor.
Treated like
proprietor.
sole proprietor.
Right.
Okay.
Yeah.
That's what, you know, we did the business challenge, that's the hardest thing to get through to people is that that's not a tax shelter.
No.
Right, no.
Well, no, it's legal protection.
Right.
And if you've got a small business, I recommend it as many people that will do it, put the whatever the business is, put it in an LLC for protection. And then when you have real estate, and it gets kind of hinky.
We can get way off topic.
Right, well, no, actually you can't. You want to know why? Because if we can go look at the balance sheet and the income statement, this is where all your questions come from.
Right.
This is really where all the questions come from, because when you start thinking about this stuff, that's how it translates into the real world.
Right.
But anyway, back to the LLC thing. If you've got 7 different properties, real estate, and you say, I'm getting an LLC so I can be legal protected, so if Johnny falls down my steps, it's on the business and not on me. But the problem with that is, you got 7 properties. Say 6 of them are paid for and they're good cash generators, and you got one that you just bought that has a huge amount of debt. Johnny falls down the steps in the building that's got the huge amount of debt that basically isn't worth any more than what you owe on it. Well, when they come calling on a lawsuit to file against you, guess what? They're going to want the value for all those properties, including the 6 that you've got paid off, because they're all part of the LLC, which is one legal entity. So in real estate, you're better off splitting every single property as a separate LLC for legal protection. And then, of course, that requires insurance on all of them, and you know how it works. When you get the GL, there's a base number, so now you're paying the base in all 7 places, but it could over time save. And of course, you can make the argument that you'd always have your real estate levered up with debt, so there's no real value there. That could be argued.
We may have a question here in just a minute, but I was gonna say, before you ask your question, so when Rodney says it's the least used, which is correct, I think it's because it's the least understood. Like I said, even for
Right.
accounting students and new accountants, so if you're sitting there thinking, I still don't really understand this, don't feel bad. Our new staff accountants don't really understand this. We have a tool for them to calculate the cash flow statement when they're preparing financial statements. And theoretically, they've been through all this in their accounting classes. And theoretically, if they pass the CPA exam, they've been tested on all this. But for whatever reason, it's just something that's not intuitive and it doesn't click. So because people don't understand it, like I'll be honest, when I present audits, people want me to present the balance sheet and the income statement and could almost care less if I present the cash flow statement because they don't really understand what it means. So I think that's why it's underutilized. It's just a lack of really an understanding of what this should be trying to tell you.
In our profession, actually, then we'll get to the question, but our profession did us a disservice when they changed the statement of cash flows. Because way back in the dinosaur days, when I started in this stuff, they actually called it the statement of sources and uses, which most people understand. So when I'm talking about cash and it's a source, that's where my money comes in from. Uses is where the money goes out at, and it made a little more sense then. But for whatever reason, we changed it to cash flows and it got complicated. It's still the same form.
This is all I know, so I have a hard time with the other one, which is required for some governmentals. Yes, ma'am.
Well, at Holston Mountain Artisans, we're a nonprofit, and we pretty well understand our cash statement. We're real glad we have an accountant doing all this for us. But where we have a hard time understanding is we're in a situation where we are buying our property from the county. It's the old jail, and so we pay so much every year. At the end of 10 or 12 years, if we paid it all off, then we would own it. It shows up as an asset each month. However, in reality, this is the real world speaking, if we were to default or try to sell it to someone else, we don't have the value of what we've already paid in our account. But like say we've already paid however much it is, let's say $20,000, it's been more than that. We can't get that money back. That money's gone. It's like a rent to own, but that money is no longer ours. It's only our property at the very end of this agreement. However, it shows up every month as our asset.
So you're saying right now there's under property, plant, and equipment, let's say it says building. So right now on your balance sheet, there's some number here.
Exactly.
But then there should also be some number down here for the debt you owe, correct?
Yes,
And they're not the
debt
same
is-
number.
No.
So the
Right.
debt goes down and the asset doesn't change?
Now, the asset changes, but we can't feel that it's an asset because it's not a value that we could take and say if we wanted to sell it to someone else, we can't, or whatever. We would never get that money back. That money is paid just like to a landlord. You never see it again.
So
it's
right
just
now, if you, so let's say, I don't know what it is, but let's say the building's on there for $500,000 and you owe $400,000 worth of debt. So what that would be telling you is right now what that building is worth to you is $100,000, let's say. It's gonna be the difference between what you put up here on the asset and what you have down here in debt. So are you saying you're like, for some legal reason, you couldn't go sell that building to somebody else if you wanted to? Let's say an
If we
independent buyer
wanted
came in
to,
and said,
yeah.
we'd like to buy this building from you.
Right, if we wanted to, we could, but it would only be the decreased value of what we haven't already paid.
Okay, so you're saying,
It's the
and
county
you'd
that
only
would be-
net $100,000 from that, because by the time you pay the
Right,
$400,000 in
right.
debt, correct?
It's just gone.
Well,
So I
it's-
don't see it as an asset.
Well,
Right. It's not gone.
No, and it's an asset because basically the way the deal's structured, at the end of the lease, you own it. You don't have to pay anything else.
That is right.
You don't have to go get a fair market value appraisal and then start paying any.
That's right.
So
So that's.
effectively, you're buying the building and your payments are mortgage payments, not
Yeah.
lease payments.
And they're very reasonable. It's
Right.
just odd to me that it's an asset now.
Well, and
Well,
so, go ahead.
It's the same way if you hadn't done a lease purchase with them, let's just say you went to the bank and borrowed the money. It's the same way. You pay that first $20,000, now you might get three or $4 grand back, The rest of it was interest, you're not getting it back either. You're only gonna get the pay down on the principal back. If you sell it for exactly what you bought it for, the most you're ever gonna get is the payback of the principal. Now, if it appreciates in value, you get the additional amount. But anytime you buy or sell an asset, if it doesn't appreciate in value, the most you can get out of it is the difference between your payoff and the sell price.
And it's not liquid, so we didn't get into really
It's not.
liquidity in this example, but right up here are the things that you could maybe turn into cash very quickly, right? You generally can't turn your property and equipment into cash very quickly, or if even at all, maybe you'd even take a loss on it if you sold it. But from an accounting perspective, like I said, in our example, if your building was worth $500,000, and it's depreciating a little bit each year, but probably over 39 years, so not a lot. Hopefully your debt is going down faster than the depreciation on your building. So every year, every month, when you look at that again, the difference between here and here should continue to expand up until the time that you pay it off. And then maybe it'll feel more like you have something in your hands once the debt is paid off. Right. But the reason they do that, if you just didn't put that on there at all, and somebody was looking at you as an entity, whether as an investor or whatever, if I was investing in you all as a company or I wanted to be a donor, I would want to know, I'd want to know how much debt you have out there. And if it's secured debt, I would want to know what theoretically the value of the building is worth, which really isn't correct because accounting is historical basis. So let's say you have the building on there at $500,000, but it's appreciated in value. Maybe now it's worth $550,000, maybe it's worth $600,000. That won't show up here because this is not done at current fair value, it's done at historical cost. So you wouldn't even see that additional appreciation here until you sold it, or unless we move to fair value, true fair value accounting.
And that can happen in other places too.
And that can happen in other places too. But full accrual accounting, the object of it is to tell the true story of your business. Every liability, everything you've obligated yourself to, even if you haven't paid the cash, all sources of revenue that somebody's already obligated to you are coming in, like grants or things like that, even if they have pledges, even if they haven't paid it. It's to tell the reader the whole story, not only what's right here, right now, but what's supposed to be coming in the next 12 months, theoretically. 12 months for current, long-term, more than 12 months for long-term. That's a very good question. Anybody else have any questions on either the cash flow or the just kind of a set of financial statements themselves?
But this is the most important number on the balance sheet for most people in a small business. And that comes from the statement of cash flows, which is why it's so important.
We'll go on to calculating a break even, and then we can certainly come back. If there's any more questions, we can come back to that at the end.
All right, the break-even point or break-even level represents the sales amount, either in quantity or units or dollar revenue that's required to cover the costs consisting of both fixed and variable costs to the company. Fairly straightforward. So this is the issue because this can be variable, obviously, by definition, but those are the things that catch most people when they're starting a new business and they're trying to figure out what my service should be worth, how much should I sell my widgets for. This is the number that catches people. This stuff's obvious most of the time, but this is the one that catches. And then, of course, if you operate at break even, then there is no profit, because technically break even is the zero profit number.
Sorry, yeah, you just put your little cursor right there, and I just have it.
So when you're trying to figure out break even, these are the things you're going to have to consider. Obviously, the sales price or the unit price if you're doing it by units. Direct, this should be slash or and. Your direct and your variable costs. And direct and variable can also be split between, well, the direct can, but the variable costs can also be direct costs, or variable costs can be indirect. But this one, that's what I said, this is the one that causes most issue. Of course, your sales price less your cost, less your direct costs, gets you to gross profit, less your other fixed, or in most cases not very, but your other fixed costs, gets you to your net income, which is the number that you need to calculate your break-even analysis from. And then the other thing to consider is, and it's what different, because it's the driver for the variable cost piece or the direct or how it's going to function, is what the operating metrics of the business is. And it is amazing to me that I have clients that have done what they do for 25 years, and if I walk in and say, okay, what's the one thing you've got to see to tell what your business is doing? And some of them don't really know. They literally they're successful because they work hard and they're good at what they do, but they don't really understand their own business as far as what this item is. Which is fine if you want to work a job, but if you want to build an empire to sell to somebody else and make money from it, you've got to understand that, because that's how you sell it. Because people, I mean, if people come in to look at your business from an acquisition standpoint, they understand what the numbers say. This is the part they want to know, because this tells them how the business is run. And it can be different depending on what kind of industry you're in. So if you're doing a service, it's a little easier to understand operating metrics. It's either an hourly rate or a fixed rate. So if I go install a toilet and I charge $80, then that's the metrics is how many toilets did I install times the 80. I mean, it's an easy number. But it can get a whole lot more complicated depending on what it is, if you're manufacturing or what service you provide.
So Rodney, just the direct and variable costs, will you define those for?
Yeah, your direct costs are mostly related to either a retail sale operation or a manufacturer. Service can actually have some direct cost if you cost it that way, but for the most part, people treat, if you're in a service business, you'll have sales, no cost of sales, and then everything else is treated as a operating expense. But direct costs, like if you're manufacturing trailers, you've got tires, you've got wire, lights, bolts, nuts, steel, wood, all those things are your direct costs. And they are also the costs that are variable, because how much I spend on lumber depends on how many units I make. So that's where the variable aspect of it comes in. Your fixed costs are the building that I'm operating in. Under normal circumstances, whether you do one trailer or 1,000, you've got to have some set number of people. That labor then becomes a fixed cost. If you have an accounting staff, that's a fixed cost. Utilities on your building are fixed and variable. So if you have to turn the lights on every day, but if all you do is turn on the lights, it's not the same as turning on the lights and going out and running the shop and generating 500 trailers. So again, the variable and fixed stuff mixes just like the direct and variable do.
Could I ask you can you define operating metrics again?
Yeah, the operating metrics are basically, these are the things you would look at. So when I was in the explosives business, what we did was we blew up dirt. And the thing that we looked at was how much dirt, because we were basically we were selling blown up dirt. So we used bank cubic yards. So we would measure in a drill bench how much dirt we blew up. So then it would be that number based on our cost into that and the price we had set up on it. So our metrics was BCY and what the price was per BCY. Because again, we had fixed and variable costs. So our variable cost in that case was the explosives themselves, because if we're drilling 10-foot holes versus 20-foot holes, it changes the amount of money we're putting into the shot. So the cost per shot changed with the amount of money we put into the.
Can you give the example like if it were retail?
Yes. So retail store, operating metrics might be average ticket price, probably a good one.
So would you say maybe operating metrics are your non-financial numbers? In other words, they're not the numbers on the balance sheet and income statement that you have to know?
All of this is tax and regular accounting. This is mostly managerial accounting type stuff. Like I said, a restaurant. Average ticket price means a lot to a restaurant. Because you can have a room full of people and everybody's sitting at tables, but if all they did is come in and buy a single drink and an appetizer, it's not the same as if they came in and they sat there and bought a whole bottle of wine, or everybody had 3 drinks and everybody got an entree and they split 4 appetizers. So your ticket price means a lot. And it's generally based in the restaurant industry on the number of people that come through the door. The other issue, or another good example of operating metrics as far as the retail goes is your space. What's your inventory in your space? Because that's a big thing to track. So if your store space is 20 by 20 and it can hold X of inventory, what dollar of inventory do you have sitting on the floor versus sitting in the stock room? Because if you have too much in the stock room, and you have to know what's on the floor to know what's in the stock room and manage that, and then see how much is going out the door and track it that way. So there's a lot of things that people, which again, most small businesses, they just do what they do because that's what they do. But the operating metrics part of it's really important if you really want to understand the details of how your business works. I mean, you can go into a lot of restaurants right now and ask the owner of the business what's your average ticket price, and there'll be some that don't have a clue. And there will be some, I actually have a client in North Carolina, he can tell you the average time from the time the doorbell rings till they get through the line and ring up the register.
So
7 minutes and 12 seconds.
It's the data intelligence, though. It's the data intelligence, the collection of the data intelligence. That should be.
It's just not used, no, because the data's there. I mean, like, restaurants are running off point of sale. Even if all you gotta do is have a cash register, it gets you the total number of tickets you rang up. And it's as simple as taking your total sales divided by the ticket number. It's just not using the information, just not. Because unfortunately, too many people run their business with the bank account. They think as long as they got money in the bank, they're good. Which, I mean, you gotta have money in the bank, and that's good. It's better than not having money in the bank. But if you have 10,000 in the bank, and you should have had 20, you'd want to know where the other 10 was.
Like in a hair salon, for instance, because that's what I know, you know, you have different prices for different types of services, and there's only 16 slots, if you will, in a day. So you take all of those that you did in a day and divide it by 16, and that would be your operating metrics.
Right, it's like an operating metric for you might be the number of customers you can serve in a day, right?
Right.
So you'd want to serve, you probably know which services, based on financial information, you probably know which services yield you the most profit. Is it a haircut or a massage? But if you have the same 16 hours or 16 slots, right, one of the things you'd want to measure is can you fill more of those slots with a more profitable? So it's not really, that's not really a sales price, a direct cost, a variable cost, but it is a number or some metric. That's why I said maybe a non-financial, maybe you want to call it a non-financial number in that.
You're talking about opportunity cost now.
Well, okay, but again, something that drives your business and determines whether you're more or less profitable, more than just the direct cost or the costs that go into that, providing that service or making that widget.
Knowing why you're profitable is always going to help you more than just knowing that you are. Because all economies aren't good, and when the economy gets bad and you don't understand how you were profitable, now you're in a mess because you can't fix it. Because you knew the items that made you profitable, you have to account for it when the market changes. So, and that, again, as far as break-even analysis, how this stuff works is, we use a restaurant again. So you've got 50, you're able to seat 50 people in your restaurant. Well, how many people do you have to seat and serve in a day to get to your break-even? Because it changes. So,
Okay, next,
we'll go to a simple example. But here's the income statement we had earlier. I had to break out the cost of sales so that we get to a gross profit. Here's your per unit number. So they're selling these widgets for $400, so they've made 1,000 of them. So how many did they have to make? Because here's our fixed costs. We've assumed that our building is going to depreciate and our equipment. We're going to have to spend that much to keep everything running in regular maintenance. They're going to have to come look at it. And this much in supplies and this much in utilities. This is to keep the doors open. So whether we make one widget or we make 10G in widgets, we're going to spend $45,000 a year. So If I've got to make 45,000 to break even, this excluded. But to break even, I've got to make 45 in gross profit. My gross profit based on my units are, so for every one of these units I make, I have to spend $300. Because it takes $220 in labor per unit, and it takes $80 of material per unit to manufacture my widget. So I make $100 for every one I do. So for me to break even in 2018, based on these scenarios, I have to make 450 units. So if I made 450 units instead of the 1,000, my sales would only be $180,000. But my cost of sales would be down also. So cost of sales at that level is going to be $135,000, which is going to make my gross profit 45, and that puts me in break even.
And then you can add, if you're doing a break-even calculation, you can add the desired, your desired income for the year.
Right.
Your desired profit for the year.
Yep. You can basically, once you know where your break even, actually this is the driver of everything. If you're manufacturing or making something, even like if you're in a restaurant, if you know your margin's going to be 40%, and you know that you've got rent, utilities, and a manager who works whether they're doing anything else or not, that you're not treating as cost of sales, but like as an admin person, and insurance, which isn't on here, and advertising. If you know that you're going to spend $100,000 this year in fixed expenses, no, let's make it $400,000. If you're going to spend $400,000 and you know that you're going to work on a 40% margin, then you've got to come up with $1 million in revenue to break even, because you can do it that way. Because you can basically take the percentage of your gross profit, divide your total cost, fixed cost, by your percentage of your gross profit, and it'll tell you how much you have to sell to break even. And then the most important part of that is if you know you got to sell $1 million in sales, and your average ticket price is $20, what's that now? 500,000 people. So you got to serve 500,000 people. Well, if you have 50 tabletop, you can seat 50 people, and you got to generate $500,000. Then that's how many people you have to serve?
100,000.
All right, so 100,000 people have to cycle.
We're accountants, we have to have calculators to do that.
100,000 people have to cycle across those 50 tables
In 365 days.
in 365 days. And you're only open Monday through Friday. You're open Monday through Friday from 11 to 3. And then you just do the math, and then you got it.
Right.
And at that point, you say, okay, I have to serve 27 people every day if I'm going to make it. And then when you know you're making money, when you start selling to 30, at that point you're making money. And when you sell 300, you franchise.
Or you can increase prices.
Right.
If you have a like in that example, if you know you want to make $1 million, you may say, well, I can't do that at these prices. So now I've got to reset my sales price. Again, whether it's a service fee or a widget. And it can get a lot dicier than this, because what Rodney was saying earlier is some of these things can be both. Because for instance, payroll. Well, right now we've got it as a variable, but honestly, some of that is really, again, you're going to have some payroll expense, whether you make one widget or 1,000 widgets.
This is always going to be both. This is always going to be both. This is always going to be both. This is always going to be both.
So,
you just have to understand.
I mean, it can start to get to be complicated math, but just breaking it down into those basic categories.
And the other thing too, on the metrics thing and tracking, like what you got to have as far as an average ticket price to make your profit. Like the restaurant example, I have a client that has a barbecue restaurant, and pork prices are going up, but you can't just jump in and change your menu because pork, it's not like the gas, you can't go out every day. Oh yeah, barbecue's 75 cents higher today because OPEC changed their price. It doesn't work that way. So the other reason to know it is knowing how much that pork affects the price of pork has affected your barbecue, then now your numbers change Because now to make the same amount of money, you can't serve 27 people a day, you gotta serve 35. Because you can't change your price every time that price changes. Or you run at a loss, which is never good. Because how long can you run at a loss?
Not long.
Till
Till
the
cash
money-
runs out.
Till the money gone.
Right.
Till the bank says zero, and then you're in real trouble. But break even really is calculated two ways. Just taking your total revenue less what you know your fixed costs and your variable costs are for that level of production, and then figuring out how many units it requires. So you can do it in dollars or units. So in this case, these guys have to do 450 units to break even, all things considered equal. Or they have to generate $180,000 of revenue. And sometimes that's how you look at it. You may, well, to break even, I sell 450. Well, the best I could do is manufacture 470. Then you realize you can't sell them for 1,000. You got to sell them for 1,100 or 1,250 if you want to make a living. Because if you want to make $55,000, but you can't manufacture more than 500 units, but now you need $230,000. So that just changed your per price, which in this $400 would have to go up. Because you're going to have to get more money out of fewer units. And that's how it works. But the devil really is always in the details. It's not just whatever's in the bank. It's what happened to put what's left in the bank left in there. Any questions?
We've got nonprofits in here, I guess, and we've got some small business in here, and it just depends on what type of business you have, because in the service industry, it really, your major cost there is your labor.
Yeah.
And you have to have more people because there are only 24 hours in the day. So to
Not in
increase your-
accounting.
In accounting.
We've got 26 hours a day in accounting.
But, so in
I
the
didn't know the
service
word
in-
days. I thought you were either awake or asleep.
Yeah. So in the service industry, your calculation is really mostly about your number of employees.
Right, it's
In a service,
really-
this is really a little easier
in
calculation.
your service business, it's going to be your fixed cost because you don't have any variables theoretically. I mean, you could
Right.
have variables, but for the most part in the service industry, it's all your costs are fixed. Your 10 people you've got, the building you've got, your regular utilities, cables, cell phones, auto expense, whatever it is you have, you know what those costs are. Then it's simple. If I'm going to bill my time at $200 an hour and I've got $200,000 in costs, I have to bill 1,000 hours
To break even.
to break even.
Right. But in a nonprofit, I guess what they're.
Well, the nonprofit works the
how
same,
much-
it works the same way. So if they, right,
Calculation.
building and people and costs, their cost is 500,000, then they've got to have either grants or contributions or donations of some sort to equal 500,000. Or they're going to have to borrow money to exist.
The nonprofit, because their motivation is a little different, they probably wouldn't do a break-even calculation per se. More what they tend to do is say, I can get this much revenue. I've got
They
this much
budget in
grants.
reverse.
Right, they kind of budget in reverse. They sort of look at how much income's coming in. They know their fixed costs, what's my labor, blah, blah, blah. And then after that, how much program service can I do? How many programs can I put on? Because I've got to cover, again, it could be variable in that, well, if I don't have as much revenue this year, I'm going to have to let some people go, right? Because you obviously want to put as much into program service as you can. You want to keep your general and administrative expenses to a minimum and increase your program expenses as a percentage of the total you spend. But it's a little bit in reverse. They usually start with how much revenue do I have, and based on that, I know how many people I can employ, I already know what utilities are, I know what my rent is, or my debt service is, blah, blah, blah. And usually how much they put in the program is sort of what's left. That's not,
Which I actually have a handful of nonprofits I work for that actually do it the same way small business does.
you know,
They look at their costs and then because they get no grants. They are
Okay, so
100%
they're all
privately
100%.
funded. So they look at what their costs are gonna be for the next year, and they say, okay, fundraising time, we have to raise this much
X
money.
dollars.
And then they look at the contributions that they receive from the regular contributors, and look at the regular fundraisers they do, and based on those numbers, they look at their budget, and if it fits, then they don't worry about it. But if it looks like there's gonna be a shortfall, the first thing they'll do is cut costs, and if they can't cut costs, then they find something else, we're gonna start selling T-shirts,
More bake sales, whatever, yeah.
do another event.
So you're from Holston Mountain Artisans. So how do you typically do it? I know you all probably do a budget each year, but how, again, you may never have called it break-even analysis, right? But at the end of the day, you can't run at a loss for very long, right? So how are you involved in that process at all as to how you all kind of determine, let's say you all would call it a budget instead of a break-even analysis, but it's the same thing?
Yeah. Well, we've tried that year to year.
Okay.
It's always different. The majority of our income comes from the sale of handcrafts.
Okay.
And that varies according to the economy, according to the weather.
Right.
When you get a lot of rain and cold weather, people don't get out and shop. They do eat. They get warm and eat. So it's been very, very tricky to predict, and we get a few grants, and they come in at different times of the year. And each year, like the State Virginia Commission for the of the Arts, it goes down just because their state funding goes down. So it's always, boy, it's tricky.
Right.
Some years it's a lot better than others.
Right.
And so you have a lot of these variable costs,
Yeah.
which you just cannot nail down. They're not widgets.
Right.
But it's still a variable cost if it's based on how much you can sell, then
Right.
you've got to determine.
Right.
And that's the other thing about it, because now you're getting into budgeting, and you got price and cost variances, and
It can be a lot more complicated
Volume
than this.
difference.
And you can't
Differences.
lay people off, you need shopkeepers.
Right.
Shop's gotta be open for your major stream of income. And so we try to figure out ways of, doing more events that get people to come into the shop and to go through the training programs that we offer, the classes that we offer, things like that. Because our mission is to keep the focus on the handcrafts and the craftspeople who produce them, a lot of whom are elderly
Okay.
and some are very low income. So, that's our main mission, and this is our 47th year, and it's just been, sometimes they're hanging on by our fingertips, but the town of Abington has been very, very generous over the years, helping us stay in business. But yeah, creating a budget, you do it, and then you look at it and you think, why did I say that? Where did I get that?
Sounded
idea
really
from?
good when you put it on paper, right?
Right, it's like you have to reevaluate it every month, say, depending on what the sales were this month.
well, the good thing about it is no budget or financial statement is ever wrong, because by definition, accounting is an estimate.
It's your best guess.
It is an estimate. Because you can look at the balance sheet we had earlier where it had the assets on there, and she was alluding to it. So your building, it says you have $400,000 in assets. Well, in reality, 350 of that number is a building that's appreciated and is worth $1 million. So really, your balance sheet isn't ever going to be right. And so let's say we did do fair market based,
Accounting, which we're talking about.
back to the gas change thing. Well, if your inventory is sitting in the ground in gas tanks, it changes overnight, the value of your business has changed overnight. So really, accounting is never completely right.
Right.
It's an
Right.
estimate.
I'm glad you didn't say that.
Yes.
Which is why people are so comfortable with cash accounting.
That's right.
Yeah.
Right, because they know what that is. They know
Right.
they got cash in their account, or they know
Right.
they wrote a check or sent
They
money
can
out
pick
the
their
door.
phone
They
up
know
and
what
see how
that
much the
is.
bank says they have in the bank.
Right, right. But again, and that is an important metric, right? Because you can't run your business without
Yeah.
cash. It is an important metric. But it's a very short-sighted metric. It only really tells you where you are today. So, like I have a client recently, and he's a service business, and we started him out kind of on the cash basis to sort of keep him simple. And he called me after a couple of months, he's like, did I make any money? And I said, well, it doesn't really look like you made any money, but how much do you have in invoices? How much work have you billed for that you haven't been paid? Or what are you working on right now that you haven't billed for? Well, that's, $50,000. Well, that's not reflected in this statement. You really have earned $50,000, assuming everybody's gonna pay you, right? You really earned an additional $50,000. So he may actually even wanna go to accrual counting, because even in his mind, it looks to him like he hasn't earned any money, but yet he really has, because cash isn't in the door yet. He's not seeing the benefit of really the revenue he's generated. But yes, people understand cash, but you can't run your business forever just looking at your cash balance. Somewhere, it's gonna bite you somewhere.
This section of the balance sheet, the current assets, are literally just like business. If you started an accounting firm or go to a business to work, you start out down here, and this is where that's where everybody wants, is the top. Well, in business, you want all these numbers to become cash, and they're in negative order. So prepaid is generally the hardest thing to convert to cash because it's covering an expense that had to be paid in advance. Workers' comp guy said you had to pay 60% down. Well, you're only going to get that back so fast over time. Your inventory, you can convert to cash how? By manufacturing whatever it is. If it's retail, sell it, move it to cash. If you're a manufacturer, get the inventory into finished product that can be sold and get it to cash. And your receivables is the stuff you've already sold. Collect it, it goes instantly to cash. This has to be built and then transferred to receivable, then converted to cash. Like I said, this was a little different, but that's the way you want to move. You want to move everything to cash. Because cash, I mean, it's the most important part of the business is how much you got left. Because nobody goes to work every day for a big receivable number. Because I've yet to see anybody buy bread with receivables.
Right.
And I will say too, the one thing we didn't talk about kind of back over in your break even, thing, we don't have that up on the screen. So if you're talking about sole proprietors, which we have a lot of, right? And we're talking about where's really our break even. So one of the things you might want to ask yourself, well, is that break even before or after you pay yourself a salary? So is what you're really trying to figure out, I want to pay myself, not at the end of the year, my profits, what's left over, I want $50,000. So are you doing your break even after you're paying yourself $50,000, or are you just saying, assume I make nothing, what's my break even, and then from there I'll decide how much money I want to make. So depending on you, the person doing the break even analysis for your business.
Which what I was saying earlier, when the guy, if 55 is the amount of money that whoever owns this business, if Mr. Jones wants to make 55 and he knows 450 units is his break even, then he's got to sell another 550 to pay him his 55 that he thinks his job worth. Or he works for free.
That's
Or
assuming he's not in payroll,
Right,
right? You're saying
right.
that's assuming that payroll
Yeah,
does not
that's-
cover him
he's
at
still-
all.
Yeah, he's a
Yeah.
proprietor, and that's
Yeah.
all of his people.
Yeah.
And the bottom line is all he's ever going to make.
Yeah.
Now, it's different if he's already here.
Right, that's what I said. So you just kind of have to consider
Yeah,
when you
because
talk about what
if
you
he's
talk
already
about.
here and he's basically making everything himself with one helper, and he's paying himself 60, and the other guy's getting 35 and the rest are taxes, then
He may not need to make 55.
Right.
That may change.
he may be okay with doing break even. Because he may
Right.
want to work 35-hour
Right.
weeks instead of 100-hour weeks.
But then, like you said, you're building yourself a job. I mean, that's okay. There's nothing wrong with that. If all you're trying to do is have a business to give yourself a job and an income, and that's all you want at the end of the day, that's fine. That's just a different set of goals than if you're, like Rodney said, you're trying to expand, you want investors, or you ultimately want to sell it to somebody else for some amount of money that you can then, whatever, retire,
Which, I
go
mean,
do something with.
that's the real importance of the break-even analysis. Because if your business is to pay you a salary, then you know how much you want to make, then you know how much you have to sell or make to make that much money. And then if your plan is to build a bigger business, then what number do you have to get to here? You know where your break-even is. How far do you have to push this to make your business attractive to somebody else to come in and say, hey, instead of me buying widgets from you, I'd like to buy the company and make it for myself. Because we got 6 other places that we can move those widgets to that you can't logistically service, but if we did them ourselves, we could do it. That kind of stuff will happen. 2 very important things that most people don't understand about their own business that's very important to understand.
Any other questions? I don't know how we're doing on time. I didn't keep a clock with me. Oh, there we are. Okay, so we're pretty good.
So does anybody have any questions about specific? Okay,
Okay.
well.
Thank y'all very much for having us.
Jennifer, is this? Yep.
we have Karen and Rodney's contact information, or if you'd like to talk to them more about, individual specific items, we'll hold on to them for a minute after the class. Our next class is in 2 weeks, and it is how to use video effectively for marketing, which marketing is
Use that one myself.
always our big topic. So thank you for coming today, and we will see you in 2 weeks.
Great. Thank y'all very much.